Welcome back, everybody, to another deep dive. We love to dig into these investment classics, and today we're diving into the afterword of The Warren Buffett Way by Robert G. Hagstrom.
A fascinating choice. This isn't just a typical book summary.
Mhm.
It's actually Hagstrom reflecting on how Buffett's methods have held up over time. And he shares some really interesting personal anecdotes along the way.
So the setup here is great. He takes us back to 1984 when he was a young broker at Legg Mason just starting out.
Uh,
And like any doobie, he's given a stack of materials to learn the ropes.
oh, I can imagine. Probably feeling a bit overwhelmed.
Totally. And among those materials were two key things that would change his whole outlook on investing. The Intelligent Investor by Benjamin Graham, a value investing classic,
Oh, yeah. A must-read for any serious investor.
and the 1983 Berkshire Hathaway Annual Report.
Now that's where things get interesting.
Great.
Buffett's letters are legendary.
Exactly. At first, Hagstrom admits he's just trying to absorb all this new information.
Yeah.
But as he's reading Buffett's letter to shareholders, there's this one line that jumps out at him. Buffett writes, "Our long-term economic goal is to maximize the average annual rate of gain in intrinsic value on a per-share basis."
Intrinsic value. Now that's the heart of value investing, isn't it?
And for Hagstrom, this was like a light bulb moment.
Right.
It's like he finally understood that stocks aren't just numbers on a screen. They represent ownership in actual businesses.
It's a fundamental shift in perspective.
Right.
From gambling on price movements to understanding the underlying value of a company.
Absolutely.
Yeah.
And from that point on, Hagstrom was hooked. He becomes obsessed with Buffett. Buffett devours everything he can find about him, his investments, his philosophy, and he even starts applying those principles when managing money for his clients.
So he's putting theory into practice, looking for those great businesses that are undervalued by the market.
And it works. He sees some really good returns early on, but there's a catch. Some of his clients start getting impatient. They're not seeing the quick gains they expected, and they end up pulling out.
That age-old problem. Patience is key in investing, but it's often in short supply.
And this is something Buffett emphasizes all the time, tuning out the noise and focusing on the long game.
Which can be tough when the market is swinging wildly, emotions run high.
For sure. So now Hagstrom is riding high. He's having success applying Buffett's methods and decides to launch a mutual fund based entirely on those principles.
Sounds like a recipe for success. Right, if it works for your clients, why not scale it up?
You'd think so. But here's where things get really interesting. The fund's performance is actually pretty lackluster. Not what he expected at all.
That's a twist. What happened? Did he misinterpret something about Buffett's approach?
Well, partly because the market was starting to shift. This is the late 1990s, and the tech boom is in full swing.
Ah, yes, the dot-com era. Those were some crazy times.
Yeah.
A lot of investors were piling into these tech companies with promises of massive growth.
Exactly. And those traditional Buffett-type stocks that Hagstrom was focused on, they weren't keeping up with the hype.
So now he's facing a real dilemma. Can a value investing philosophy rooted in understanding those more traditional businesses keep up in this new tech-driven world?
It's like the rules of the game were changing, and he wasn't sure if Buffett's playbook was still relevant.
And this is where the story gets even more intriguing because it introduces another key figure in this tale, a guy named Bill Miller.
Oh, this is where it gets good, right? Tell me more about Bill Miller. Bill Miller's this investor who's making a name for himself, and he's actually a friend of Hagstrom's. They've talked about Buffett's methods and bounced ideas around.
So they're both on the same wavelength when it comes to value investing.
Yeah, and what's fascinating is that Miller is finding success applying those principles, but in a sector that you wouldn't typically associate with value investing tech companies.
Now that's interesting. You think of those high-growth tech companies and you wouldn't immediately think value investing?
Right. They often burn through cash in the early stages. Exactly. And that makes it tricky for someone following Buffett's approach, who's all about steady earnings and solid fundamentals. But Miller, he's not just chasing hype. He's actually digging deep into the business models of companies like Microsoft.
Trying to understand how they generate cash, how strong their competitive advantage is, and whether their intrinsic value justifies those sky-high valuations.
So it's not just about looking at the price tag, it's about understanding the machinery under the hood.
Precisely. He's asking those tough questions. Is this growth sustainable? Can they actually turn a profit?
And his success really challenges this idea that technology companies are somehow exempt from value investing principles.
It's a wake-up call for those who thought Buffett's approach was becoming outdated. It's like he's saying, hey, these principles, they're adaptable, they can work even in these new and exciting sectors.
So what does Hagstrom do? Does he stick to his guns? Or does he take a page from Miller's playbook?
Well, he's clearly intrigued by what Miller is doing.
Hmm.
And eventually he decides to join him at Legg Mason Capital Management.
Wow, so he's expanding his horizons, moving beyond those traditional Buffett-type companies.
Exactly. It's a turning point for him. He realizes that Buffett's approach isn't limited to specific industries. It's a framework for analyzing any business.
And that's a really powerful realization, isn't it? It's not about blindly copying Buffett's stock picks. It's about understanding the principles behind his decisions.
Absolutely. It's about thinking like an owner, focusing on those long-term fundamentals and being able to adapt to different market environments.
And this is where Hagstrom brings up this fascinating study by Michael Mauboussin, who was at Legg Mason at the time.
Oh, yeah. Mersons' work is always insightful. What did he find?
Well, he looked at these top-performing mutual funds over a decade and discovered that they had a few things in common. They had low turnover, so they weren't constantly trading in and out of stocks.
Interesting. So they weren't chasing those short-term gains.
Exactly. They held concentrated portfolios, meaning they focused on a smaller number of companies that they really understood.
Makes sense. Right. If you spread yourself too thin, it's hard to really know your investments inside and out.
And of course, they all followed an intrinsic value approach, just like Buffett.
So far, so good. But there was another interesting finding that Mauboussin uncovered. These top funds were all geographically located outside of those major financial hubs.
So not on Wall Street.
Nope. It's like being away from all that frenzy and noise actually helped them stay focused on the fundamentals.
Maybe it's easier to think clearly when you're not caught up in the day-to-day market drama.
It's an intriguing thought, isn't it? Like they were able to tune out the distractions and just concentrate on those long-term drivers of value.
So it seems like there's a lot of evidence to support this idea that a value-oriented approach can be successful, even as the market landscape changes.
Absolutely. But as Hagstrom points out, many money managers still struggle to beat the market.
So does that mean it's become too hard to find those hidden gems, those undervalued companies?
Well, it's certainly more challenging, but it's not impossible. And here's where Bill Miller's perspective is so insightful. He says, and I'm paraphrasing here, just because the S&P 500 consistently outperforms most active managers doesn't mean active management is flawed. It just means most managers aren't doing it right.
So they're focusing on the wrong things,
Yeah.
like trying to time the market or chase short-term trends.
Exactly. They're not putting in the work to really understand those underlying businesses and identify those long-term opportunities.
And this is where the market being more efficient actually comes into play.
Right.
It means you need to be even sharper in your analysis.
Absolutely. You can't just rely on surface-level metrics. You need to dig deeper, understand those subtle shifts in a company's competitive landscape, and identify those businesses that are poised to create value over the long haul.
So it's still possible to find those mispriced opportunities, but it requires a deeper level of understanding.
And a willingness to go against the crowd, to be a contrarian when everyone else is chasing the latest fad.
And that brings us to this great anecdote that Hagstrom shares about the 2004 Berkshire Hathaway annual meeting.
Oh, I love these behind-the-scenes stories. What happened?
Well, a shareholder asks Buffett if, looking back over his career, he would change anything about his investment approach.
I'm on the edge of my seat. What did the Oracle of Omaha say?
And get this, Buffett's response was basically, if we had to do it all over again, we'd do it pretty much the same way.
Wow. So he's sticking to his guns. He believes those core principles are still valid even in a rapidly changing world.
Exactly. But it's not about blindly following a set of rules. It's about understanding the essence of his approach, the thinking process, and adapting that to the current market environment. And that's a really important point, isn't it? It's not just about specific stocks or sectors. It's about developing that investor mindset that can adapt and thrive over the long term.
Absolutely. It's about constantly learning and evolving as the market changes.
And I think there's a bigger lesson here, too, that goes beyond investing. It's about having a framework for making decisions in any area of life.
Oh, I like that. You know, we're bombarded with so much information these days. It's easy to get caught up in the short-term noise.
Exactly. So whether it's your finances, your career, or even personal relationships, having those guiding principles, those long-term goals, can really help you stay grounded and make those sound decisions.
It's about cutting through the clutter and focusing on what truly matters.
So as we wrap up this deep dive into Warren Buffett's world, what would you say is the most important takeaway for our listeners, something they can apply to their own financial lives?
Well, I think the biggest thing is to remember that when you buy a stock, you're buying a piece of a business.
It's not just a ticker symbol on a screen.
Right. It's about understanding that company's story, its products, its management, its competitive landscape.
So it's like putting on your detective hat and doing some serious research.
Exactly. And once you have a good grasp of the business, you can start evaluating its intrinsic value. Is the stock price reflecting the true worth of that company?
And of course, patience is key. Don't panic and sell
Mm.
just because the market is having a bad day.
If you believe in the long-term prospects of that business, you need to have the conviction to stay the course.
So it all comes down to doing your homework, understanding the fundamentals, and having that long-term perspective.
And being willing to be a bit of a contrarian sometimes.
That's right. Well, there you have it, folks. We've explored the world of Warren Buffett through the insightful lens of Robert G. Hagstrom.
It's been a fascinating journey, full of valuable lessons.
And I hope our listeners have walked away with some new tools and ideas for approaching their own financial decisions.
Remember, investing is a lifelong journey. It's about constantly learning and adapting.
And always seeking to understand the businesses behind those stocks.
So keep asking questions, keep digging deeper, and never lose sight of that long-term perspective.
Thanks for joining us on this deep dive into the Warren Buffett way. We'll see you next time.